I think we have to begin with some reaction to what you've just heard. It's a pretty tough question. I know you can handle it, so here goes. What's going to happen is the Fed is likely to be cutting interest rates as we inch closer towards the US election. That could potentially give President Biden a boost, but it could also invite criticism from former President Donald Trump. Does it matter to markets who wins this election?
A tough question, as you say. I would say it doesn't matter that much. If you think basically both candidates are running loose fiscal deficits and very stimulative economic agenda. Under Mr. Biden, we see still a very large fiscal deficit, and therefore I don't think it matters too much. It's probably one of the reasons why inflation is holding up better than originally expected, and that probably also puts a little bit of a brake towards the Fed on when they can start to cut. We still think they will cut, probably in June, July, latest in September, but that's definitely one of the key aspects. The other positive news, of course, is growth is relatively robust and resilient, and therefore we actually do think going into election year that the growth part will actually be not a decisive matter when it comes to the two candidates and who will win.
Indeed. And look, the Fed is cutting into a stronger economy, right? So it seems as if it's in no rush right now to advance any of these rate cuts, at least for the time being. 3 rate cuts penciled in by markets. What do you think that's going to mean for equity and asset valuations moving towards the election? And are there any particular sectors that stand to benefit here? Not to labor the point on the election, we will talk about other issues, but I'm just curious to get your take on this.
Well, we went back for the last 60 years. We basically looked into the behavior of the equity market 12 months before the first interest rate cut and 12 months after the first interest rate cut after a long cycle. And what we clearly can see, there's a distinct difference if the economy is in a recession and the Fed has to cut interest rates because they have to stimulate growth. That actually leads to a declining equity market before the first rate cut, but also means that after the first cut, the market will decline for another 9 months. If you're not in a recession, which is our base case, then you actually go into a stronger equity market into the first rate cut, and that will last for another 12 months, and I think that's where we are. So the Fed will cut, it will adjust their monetary policy, but they want to stay neutral in their monetary policy, just basically lower the interest rates towards the growth side, which also has started to fade a bit, but as said, remains afloat. And that should be fairly positive for equity markets. That means higher valuation, that means earnings can grow, and that means that we will see higher equity markets until the end of the year.
Okay, fascinating to watch. And Adrian, just before I let you go, a two-pronged question here, because this is important, influencing market activity today. China's industrial profits data showing signs of stabilization. What would you need to see in China to upgrade your neutral stance? And then as a second point, while we have you, yen also continuing to fall. At what point might we see intervention in the currency?
Well, on China, very quickly, look, I think the government is doing the right thing. Quality growth will actually pick up, and nominal growth will pick up. Real GDP growth will slightly decelerate, but I think it's the right thing to do. I think what we would need to see is that earnings growth shows a confirmation of continuing growth. And then it's the investor confidence that slowly should come back. But I'm just coming back from the Art Basel, and I can see that mainland Chinese tourists start to travel again. They want to spend, they're going out. And I think that's a very encouraging sign. And therefore, I do think that China can do well. But we wait a little bit to see the confirmation also in rising equity markets before we upgrade. And on Japanese yen, probably more pressure as long as this interest rate differential remains to the US. So I think it's probably rather we have to see the US starting to cut interest rates, and then we will start to materialize the value we actually see in the Japanese yen.